Welcome, everyone, to the Bernie Company's quarterly webinar. This is Lowell Pratt, and I'm joined today by Adam Newman. Stocks advanced sharply in 2019, so it's natural following such a year to have valuation concerns. In fact, we got a question already from the audience regarding whether or not we're facing irrational exuberance in this market. And it's a well-timed question and one that I plan to address. There are many approaches to determining whether equities are reasonably priced relative to their fundamentals. Many of these are getting a lot of press right now, but there is clearly one best method of making that determination, and it's using discounted cash flow analysis. Dr. Damodaran, who's the professor at New York University Stern Business School, is considered the authority on this subject. He's known as the Dean of Valuation. For any that are interested in more details, he's got an excellent website filled with his analyses that you can pour into this in more detail. Discount valuation, the math itself sounds a little bit scary, but when you boil it down, it's really a pretty simple process of discounting future expected cash flows to a net present value. There's a discount rate, which is what's depicted in the chart on this screen, that involves two components. There's a risk-free rate. The convention is to use treasury bonds. And then there's an equity risk premium, which is the excess return equity investors earn for owning riskier stocks. Over the past 25 years in the table, you can see that the components of the discount rate and the total discount rate. The total discount rate has averaged 8.2. That is essentially what the market forecast of returns ahead are. The range, as you can see, is roughly 7 to 9%. Right now in 2019, at the end of the year, we ended up at the shorter end of that range. That is a forecast for less than average returns ahead. The equity risk premium is another component of this table. As you can see, its range has been roughly 3 to 6%. The average has been 4.4% over this period of time. When the discount rate is high, so when you have a high equity risk premium, that is an indication of stocks being cheap. It's said another way, it's a time where investors are demanding excess return above the treasury bonds. When equity risk premiums are low, it's the opposite determination. That's where there's evidence of enthusiasm for stocks, greater than normal enthusiasm for stocks, and that's also typically a time where stocks are expensive. So as you can see, the equity risk premium at the end of 2019 was 5.2%. That is a pretty hefty premium, actually, and is an indication that stocks are not overpriced. It's kind of interesting. Part of what's causing that, though, is the fact that we have unusually low treasury bond rates. If you look back through time, you can go back actually many more than 25 years. You're not going to see treasury bond rates as low as they are right now very often. As you can tell from the chart, there's kind of a minimum discount rate that investors demand. No matter what the treasury bond rate becomes, they seem to demand something in the at least 7 and 8% range for compensation for their risk. Another stock market concern is periods where the market has, to borrow the phrase, irrational exuberance. I'm going to define a speculative company as a company that has no operating earnings, or more correctly, negative operating earnings. There's always times where you have these kinds of companies present in the market. Following recessions, which are the gray bars of the chart, you can see that speculative companies increased pretty significantly. The last two recessions, they spiked to become 20% of the S&P 500 constituents. As on equal dollar basis and spiked on a market cap weighted basis above 5%. So there are times where it's natural in the economic cycle for companies to have negative operating earnings. At other times, though, it's not as common. And there's a dangerous period that we see in this chart in the late 90s where, and this was for investors that were around then, this was the dot-com era, where we had a sort of sudden spike in the percentage of companies that were operating with operating losses, and as a percent of market cap throughout the mid to late 90s, you can see that steadily rising, and that's a dangerous sign when you see that. If you advance the clock to something closer till now, you can see that really all the way through the 2010 decade, we had a fairly high number of companies that were operating with negative losses. This is a lot of the technology companies that are becoming more and more dominant. There was a time peaking around 2016 where the percentage of those companies actually as a percent of market cap actually became somewhat similar to what we saw back in the late 90s. And that was something that was concerning then. As you can see now, many of these companies have become profitable, so they're no longer defined as speculative by the definition that we're using. And we're back now from a percent of market cap basis to a pretty natural level. And this is another indication that that we don't have excesses built into the pricing of stocks in the market. What we're looking at on this next chart is the market cycling with respect to style, value versus growth. Many of you will be familiar with this. This is what underpins really the core size and style responsive strategy that we utilize. There's times where the market favors growth. There's times when the market favors value. There's a lot of momentum that determines when the market makes its rotations from one phase to another. In addition to momentum, there's also fundamentals involved. And what we're looking at right here is the same discount math, the cash flow discount math that Damodaran uses for his overall market valuations. It's now being used to evaluate the relative priciness of growth stocks relative to value stocks. As you can see, the black line in the middle, it's natural for growth stocks to be priced at a premium. The average over time, over this period of time, is about 1.5 to 1 is the ratio of growth stock valuation to value stock valuation. There are times where growth stocks become priced much more dearly than that. You can see that they can climb as high as 2 in the beginning of this period. You can see them, peaking at 1.8 and 9 as kind of a natural kind of peak valuation of growth relative to value. And then there's times where the market rotates and value stocks become more popular. And when that happens at the end of those phases, you're going to see relative valuations approaching closer to parity. So, in one instance, we almost got all the way to parity. That would be very unnatural. Anything below about a 1.3 to 1 ratio would be an indication that value stocks have become pricey relative to their opposite. So what we have right now, if you look at the far right of this chart, is an indication that on a relative basis, growth stocks have become fairly pricey relative to value. This is part of what we use to drive our decision making regarding how to position with respect to value and growth. So this is part of our motivation for shifting portfolios recently from a growth bet to a neutral bet, and now all the way to a value shift in our portfolios. So Adam is going to cover this in more detail, and at this point, I'll turn this over to Adam.
Thanks, Lowell. And yeah, just in a bit, we'll get back into the growth versus value discussion, and specifically how that pertains into changes that we've made within our size and style responsive strategy. But just in general, taking a look back at what happened in 2019 in the fourth quarter specifically across the broad asset classes. We've got, as we typically do, on the left-hand side, the equity sub-asset classes broken out by region, and on the right-hand side, the fixed income markets. So I think if you look at most of any quarters in 2019, we came out somewhere near, at the very least, flat, and in a couple of instances, fairly positive on a quarterly basis. So the U.S. market was up just under 10%. Overseas, you had the developed markets, which were up just about 8%, and emerging markets being the top performing global equity asset class for the quarter, up around 12%. Finally starting to rebound after some choppiness in 2018 and the first part of 2019. Real estate came through relatively flat, as did the bond markets. And so, the way that real estate investments are structured, they're high income producing, so they pay fairly attractive yields, as does the bond market. And so when you get big swings in interest rates, those handful of asset classes tend to be fairly price sensitive. So towards the end of the year, we did see a little bit of a small spike in interest rates, which flattened out those asset classes, but also kept the equity markets fairly strong coming into the end of the year. So in totality, if we look at 2019, another really historical year in terms of total return for equity markets worldwide. Obviously the end of 2018, lots of questions, lots of concerns with the almost 20% downward movement we had in indexes in Q4 2018, but really started with a strong rebound in January and continued through most of the year across the board, positive returns, even the fixed income markets where there's just been continued questions around interest rates going up with a better economy, what's happening in the labor market and just economically in general, to see almost a 9% movement in the U.S. fixed income market is well beyond what we would have expected coming into the year. So, to piggyback off of Lowell's earlier comments about clients and the investment community in general questioning the strength of the market and what does the next phase look like, these numbers somewhat support just the directional movement that we've seen, over the last 10 years. When you've got high, almost mid to high double-digit returns domestically, and more of a subdued return environment internationally, and in the bond market, it's easy to see what's been driving most of the market upwards and where that's come from, globally. So, this snapshot here across all asset classes supports what we've seen and what we've been talking about in terms of market movements. And so, as we know, over meaningful periods of time, there's a pretty strong correlation between stock movements and the economy in general. So in the short term, there's variations and there's volatility driven by a number of different things. But overall, the economy and the market tend to move fairly in tandem over meaningful periods of time. And I think there was, let's call it, 3 key themes in the equity markets in 2019, which I think attributed to a lot of the strong performance that we saw. The first being continued accommodative monetary policy, not only here, but overseas. So the Fed cut interest rates several times, and they even, towards the end of the year, restarted their Treasury repurchase program fairly aggressively. EU overseas, they restarted their quantitative easing program, which helped the international developed markets quite a bit on the back end of the year. So both of the actions by the central banks, it's going to help with liquidity, and it's also going to help with general market sentiment. So the markets continue to be supported by the actions of central banks. The other piece of this, which came towards really a lot of the action here came in Q4, but that was the de-escalation of the U.S.-China trade dispute. So there was a lot of back and forth throughout the year and pockets of volatility in the market driven by questions around what's going to happen between the U.S. and China. And towards the end of the year, we got that, what they called the phase 1 of a trade deal in place, at least in the short term, calm down some of the worries and concerns around what a trade dispute would mean for the corporate environment domestically and earnings. So that was a positive. And the third big one, I think, is continued low inflation and low interest rates. So again, despite the conversation around interest rates going up, given where we are in the economic cycle, rates have stayed low, inflation has stayed well benchmarked closely around that 2% target that the Fed has. So neither of those have run away, keeping the economy in good order. And this was especially a big positive in 2019 for the consumer and the housing market. So overall, net really strong year in terms of economic growth. And the counter to that is, while we're not completely synchronized with the rest of the world, you saw a rebound, so to speak, globally in terms of economic activity. So that was a big positive. Looking ahead to 2020, and when you talk about market expectations and, what is, at least in the short term, what does the next year look like? Something to at least think about is the expectations for earnings growth. I'd say that's the one dimmer component or lackluster component of 2019 was relatively weak earnings growth for domestic companies. So there's this built-in market expectation for a pretty strong rebound there in 2020. So with the tight labor market and the economy where it is in its cycle, the market participants will be looking for, a bounce back and a bounce back in economic activity to be able to help support the stronger revenue growth. So that's just something, if there's anything to keep an eye on for next year, that would be something that'll be interesting to track. And so as Lowell talked about early on about, the headlines and the term irrational exuberance and, market participants getting overexcited about where we are, we have to acknowledge the financial media's participation in stoking some of that fear. So, any day, any publication, whether it's the Wall Street Journal, Barron's, CNBC, you can catch and pick and choose different headlines. But if I pull this slide up without a date and without a benchmark point, this will probably sound and look fairly familiar to a lot of what you're hearing right now. So a bull market with signs of aging, questions about whether or not the market's running out of steam, whether or not you should stick with your investment plan or maybe sit on the sidelines and wait for some of these uncertainties to settle down. And so if I told you that this was something pulled out of today's journal, you probably wouldn't disagree with me. But in fact, this was actually taken from December in 2009, really about 8 or 9 months after the bottom of the financial crisis, and we had a very short-term, really strong rally in the market. So, again, there are biases in both directions, and we can pick and choose headlines to try and confirm what we think to be true or, scare us into making big investment changes. But, this bull market from start to finish, and this was really just about the start, has been one of the more questioned rallies that we've seen. And so these types of headlines and fears, although today they feel a little more real given how long we've been going at this 10 plus years now, they followed us pretty much most of the way through. And that's really what it comes down to, markets and the equity risk premium, the way that we're rewarded, and the reason why we demand that risk premium really boils down to uncertainty. So without uncertainty, there's really no risk, and without risk, there's no excess return. And so as we look back, before we look a little bit more forward, as we look back in what was happening in the last decade, some of the major uncertainties that helped drive the market and keep the market rally going, we had a U.S. credit rating downgrade. We had debt problems in Europe, negative interest rates, Brexit, the 2016 election. We had recessions abroad in Europe and Japan. We had a lot of new disruptive technologies come to the market and questions around how they were going to change the way that companies do business and make money. And of course, geopolitical turmoil in the Middle East. And I could probably add any number of additional items to this list. These were the big ones. But this is really the price that we pay for those excess equity returns over something that's risk-free, like cash or a T-bill. And so we know in the next 10 years, without a doubt, there will be another list of uncertainties for us to point to, some of which we already have built in our repertoire through the first month of the year. But as we put volatility in perspective, I thought that this was really interesting. We go back several decades, all the way back to the 1930s, and we break out each decade into its own time period, and we look at what was the annualized return, so average return per year over that decade, and what was the annualized standard deviation attached to that return. So the higher the standard deviation, the more volatility, the more bouncing around you're going to get in the markets, the lower the standard deviation, the calmer the markets are going to be. So as we look back, we parse through that list of uncertainties and what we saw coming out of the financial crisis and what our expectations might have been. The decade ending 2019 was certainly one of the stronger performing periods, but also in terms of standard deviation, one of the less volatile. So just an interesting observation, as we think of what's ahead and what in the period that we're coming out of. With that, we'll take a quick look at our size and style responsive strategy and give you an update there. This is an update as of the end of 2019 of the various size and style quadrants and their relative performance for the year. So I think on an overall basis, we still had from start to finish a strong year for growth. Most of that's coming earlier on in the year. And then on the back end of the year, you started to get, as Lowell said, some of that really significant momentum in value. So we still did see a performance gap between growth and value in 2019. And, as that changes and we evaluate our posturing, we try to evaluate that momentum and identify and recognize what are the adjustments that need to be made to account for that. And so as we spoke during our last quarterly webinar, we did, in the last 18 months, we've really made a shift from a growth tilt to a neutral tilt to a value tilt. And so as of the last time we reviewed this, we were about 60% value, 40% growth. And most recently, in the last couple of months, we've updated that positioning to 70% value. So a 10% increase on the value side, a 10% subsequent decrease on the growth end of things. So we're still certainly seeing and evaluating that momentum as it comes to value versus growth. And so a lot of the changes that you'll see in your equity portfolio will be as a result of this repositioning. Clients with taxable assets and taxable accounts, you will probably see a pickup in activity in the first part of this year, given the tax impact of doing significant selling at year end. So that's a conversation you'll have with your designated advisor on our team around your tax sensitivity, your tax situation. But this is really what we're looking at now in terms of targets. On the large versus small end of the spectrum, there's been no change. So the positioning as it relates to large cap versus small cap is still 70-30. So the adjustments that have been made in our size and style responsive portfolios have all been on the value versus growth end of things. So that from an investment standpoint, in terms of where the markets are, in terms of our positioning as it relates to size and style and looking ahead, I think that's a good summary for the start of the year in terms of what we're thinking and what we're observing. Something that came to the table non-market related towards the end of the last year was the passing of what's known as the Secure Act. And so I myself, among other advisors, have found that some clients are not necessarily familiar with these significant changes and what they might mean for you. So I thought it would be helpful as we hit the tail end of our time to just give you a quick summary of the Secure Act and what I think are the three most relevant points of consideration when it comes to planning and thinking about retirement in general. So really at the last, what was the 11th or even the 12th hour of 2019, Congress put through some significant changes, legislative changes for retirees. And so there's three items that we think are going to be most relevant as it relates to clients. The first being a change in the age at which you need to begin taking mandatory distributions from retirement plans. So those of you that are familiar with required minimum distributions, for many, many years, it's been the understanding that you need to begin taking required distributions from qualified plans and IRAs in the year in which you turn 70 and a half. They pushed that back. That now begins in the year in which you turn 72. So a positive from a planning perspective, from a tax planning perspective especially, is that those that were going to be turning 70 and a half sometime in the near future, you get a delay in needing to take those. So that gives you a little bit more time to better plan for it and understand what that might mean for your situation. The second change is related to inheriting IRA assets. And I have to emphasize that this is inheriting IRA assets as a non-spouse. So the way that it works today is if you inherit someone's IRA and they're your spouse, you can roll their IRA into your own and continue to proceed as if nothing changed. So as if you were always the owner of those assets. So that means the timing of your RMDs, when you need to take distributions, and how you want to manage those is all up to you as a spouse. If you inherit an IRA as a non-spouse, now you've got a 10-year window that you need to fully liquidate that account. So previously, if you were an IRA owner and your son or daughter inherited your account and they were in their 40s, they would be able to take minimum distributions over the rest of their lives. So that could be many, many decades. Now, this was a revenue generating provision of the Secure Act. The IRS said, we want all of that money within 10 years. So that money's got to come out within a 10-year period. Really significant from a tax planning standpoint if we see tax rates go up in the future, and then you've got to take these big distributions from retirement accounts in a short window of time. Definitely something to consider and think about from a planning standpoint. The last piece of this, again, I think it's relevant because I see a lot of clients continuing to work past 70 with longevity and with people wanting to stay active. It used to be that once you hit 70 and a half, you could no longer make a contribution to a traditional IRA. For whatever reason, you could always continue to make Roth IRA contributions past 70 and a half, but you could not make any contributions to an IRA, whether deductible or non-deductible, past 70 and a half. The Secure Act went away with that rule. So if you've got income up to any age, you can make that deposit into an IRA if it makes sense for you at the time. So those are the three big things. And as we're communicating with clients through the quarter and the first half of the year, it's very likely that these items will come up in conversation. But we wanted to just get ahead of it and make you aware of what we think are the three most relevant changes for our clients. So we're just at about 30 minutes here, keeping things brief so that people can get back with their day. So hopefully this has been helpful. We've covered 2019, we've looked backwards, we've looked forward, and we've also touched on a little bit of retirement changes that are relevant. So any questions, anything that comes up on your end, please feel free to reach out to your advisor or team and let us know. Also, we will be recording this webinar and posting it to our website in the next several days. So thank you and hope everyone has a great rest of their week.